Oh, there we
Oh,
go.
all right, there we
We
go.
figured it out. Hello and welcome to another episode of For the Love of Sports. My name is Michael Rasile. This is the show where I get to talk about sports, I get to talk about business, and I get to talk about everything in between. Today, we're going to be talking a lot about sports betting. I have my man Lloyd Danzig, founder and CEO of Sharp Alpha Advisors. Lloyd's been on the show before, so if you want to hear a little bit more about his backstory, how he got to this point of being a sports betting aficionado, sports betting consultant, all these other things that he's doing, go back and listen to that episode. I'll make sure it's in the show notes for everybody. But we're here to just talk about some of the crazy stuff that's been going on. But first, Lloyd, how you doing today, man?
I'm doing pretty well, all things considered. The world's a crazy place, and certainly there's lots you could be upset about. But football's back. Lamar Jackson's playing against Patrick Mahomes on Monday. The Jets are terrible as always. I kind of gave up on that about 5 minutes into week one. So all things considered, I'm doing pretty well.
That might be best, honestly. Just take your emotion out of that. I don't think the Jets are going to be good. I honestly, I have this question for you. You are a Jets fan, it sounds like. Does Adam Gase even get back on the plane to come back home?
I have no idea what to make of anything. When I look at the management of the team, I step back and first of all say they had an almost unlimited budget to build a stadium for two of the most valuable franchises in any sport in the world, in the biggest market in the country, and came up with the disgusting monstrosity that is MetLife that doesn't even have a retractable dome.
Nope.
And now this season, I'm seeing Allegiant in Vegas and SoFi in LA, and I'm just saying, wow, that it just makes perfect sense. And at the team level, it looks like a college team out there. Honestly, I think this year was probably the earliest that my friends and I started talking about draft picks, which was like after the first drive, week one. Usually it's like halftime of week one. This was even earlier. Gabe, how is he still there? What's going on? Can we get a playmaker? Can we get someone to let Darnold have some time in the pocket? Your guess is as good as mine.
It's not great, but we can bet on the Jets. I think the line is +7 this week. So
I have heard
oh,
by different metrics that the Jets are reliably the team in the NFL whose fans bet the most against them as compared to on them,
wow.
Which usually is the opposite.
That is not great. I think the line opened at 7. I think it's all the way up to +11 right now, which
Oh,
I don't know. I still probably would take I think it's the Colts. I'd probably still take the Colts at this point, to be honest with you. But we don't need to make you all that depressed, man. We're here to talk
fair
about
enough.
fun stuff. We're here to talk about betting, of course. Just go hammer the Colts though, just in case. Make that your money line parlay for the week. I'm sure
There
you
you
make a
go.
little bit of money there. But Lloyd has been in the sports betting space for a while now. Again, as I said, you can go back and listen to his episode. And I think there's a lot of stuff that's going on. So I called him. I think I shot him a message. I said, "Hey, man, love to have you on the show again." He's like, "Yeah, a lot of stuff's going on. We had a nice phone call, and then we finally were able to set this up." And so one thing that we're seeing a lot of, particularly, I'm a fan of some of their personalities, not all of them, but Barstool Sports. They obviously created their partnership or acquisition. I don't even know what the heck it is. Maybe you can explain it with Penn National Gaming, which is Penn National Gaming has come in, said, "You're our media. We're going to let you do your thing, but here you go. We're going to build you an entire sports book. We're going to handle this side. You guys just give us the personalities." And immediately the first day, this past Friday, so it hasn't even been a week, it was the most downloaded sports app in the iPhone or iStore. I don't even know what the hell it's called. Whatever. The Play Store on Google. Let's say that. And it is incredible. And they have fun stuff in there. You can bet or fade with any of your favorite personalities. My favorite one was the Hanson, which was just the total of all the points. How did nobody think about this beforehand? We all want points. Just give me all of them, which I think is fun. So you can bet the over under on all the points for Sunday, which was a blast. But talk to me a little bit about this understanding that, especially with Barstool, as we're seeing, the entertainment versus investment, right? This I'm a small player, $10 here, $10 there. I'll put 50 to $100 down on a weekend, but it's over all these different things. So it makes it way more interesting. In your expertise, in your perspective, where do you see this line of the entertainment better versus the actual investment better? Like Vegas Dave, who's putting like $25,000 down on some of these games. Where do you see, I guess, the public leaning a little bit more towards?
Yeah, so I'm not sure if anyone has verified that Vegas Dave actually places the bets that he claims to place, but that's a story for another day.
Yep.
The question you're asking is actually insanely insightful, and in my opinion, cuts to one of the most important issues in anyone who's trying to invest in or be an entrepreneur in or project where this industry is going. So just to step back and kind of touch on all the things you said, the deal that happened was that Penn Gaming purchased a stake in Barstool Sports. They invested $163 million for a stake in Barstool Sports a number of months, maybe even a year ago now, valuing the company at about $500 million. That is what happened on the back end. For the front end, it is a partnership, like many partnerships you hear about, that is unfolding in the way that you described. What does Barstool bring? In audience, a loyal user base. What does Penn National bring? Two things. One you mentioned, which is technological infrastructure. The other, which in a regulated market like betting is very important, is licenses, market access, you hear it referred to as. So the minute that Barstool became a partner of Penn and started building this app, it became the case that they don't have to go through the incredibly onerous and expensive licensing process in not just one, but all the states they want to operate. I believe Penn has licenses in 18 states or something like that. And so now Barstool's sportsbook can operate in all of them. So those are the sort of implications. Now, what you're talking about is this entertainment better versus this investment better. And I think there's also maybe a third category that exists in between those two, at least for a period of time. The ones who think they're going to be profitable bettors realize
Yes.
that they can't be and become entertainment related bettors. So this is a non-scientific stat, but 99.999% of people are either entertainment bettors or become entertainment bettors. Very few people are actually profitable at sports betting. And you mentioned for yourself spreading a small amount of money across a bunch of games. The amounts of money, believe it or not, are actually not quite as relevant. There are plenty of people who are financial services professionals, work on Wall Street, bet a lot, and like to win, are competitive, want to win more than their friends, but realistically do not expect to win over the long term. And what you would find if you did an honest survey of people and they somehow reflected their own tendencies honestly, which people can't even do, what you would find is that most people in the US who make deposits at sports books never actually intend on making withdrawals. They want to stretch that deposit for as long as possible. They want to see it go up to as high a number as possible so they can take a screenshot and put it in the group chat or on Reddit or on Instagram. No question about that. But there's not an actual desire, or maybe there's a desire, there's not an actual expectation of ever withdrawing that money. And this has not really been the case, or at least not been apparent in overseas betting markets, nor has the degree to which we are very social with our betting. And a great example of that is if you go to a William Hill betting parlor, and even the nicest part of London, it's like an off-track betting parlor, maybe like an ATM vestibule. You compare that to a Vegas sports book. The least important thing in a Vegas sports book is whether the odds are minus 112 versus minus 113. That is probably the least important thing to most people who are spending money on drinks and food and just the experience. So with all that said, here comes Barstool onto the scene, ready to shake things up. And everyone was kind of dubious or skeptical or not sure how it would work out. Goldman Sachs came out and said the Barstool Sportsbook was going to be worth $4.5 billion before it even launched. And I don't think anyone doubted that they would be able to market really, really well and get a ton of publicity. And that is what the download numbers that you mentioned speak to. They shattered all sorts of records despite only being live in Pennsylvania. The 3 most highly downloaded days of any sports betting app in US history all belong to Barstool from that weekend. They did 11 million in handle on like 3 days with an average deposit of $243. And that last point is key. People were thinking maybe Barstool only caters to like a less valuable audience. And the fact that they had this many downloads and an average deposit of $243, very, very important. Now, some people say, and I think justifiably, that there's not really an apples to apples comparison to take the download numbers because other apps didn't have such a big.
Downloaded it. I downloaded. Right. I don't even. I'm not going to Pennsylvania for like 2 more weeks.
I did too, by the way.
Like,
but not only that, FanDuel and DraftKings never really had like a specific launch weekend with this much visibility. That said, it was only one state, so unquestionably they have validated their ability to generate a lot of buzz. But that wasn't really what people in the know were concerned about or skeptical about or being very pessimistic about, at least from the haters' perspective. What people were wondering is, can they pull this off from an engineering perspective? Kambi is powering their book and giving them the odds, the same company that does DraftKings and will until they move over to SB Tech. But Penn, through a subsidiary they call Penn Interactive Ventures, that's where the app and all this
Mhm.
kind of sports betting stuff in Philadelphia is run out of. It's why all the guys have moved to Philly. They hired 65 engineers. And especially when they failed to get the app up for week one, some people were saying, oh, this is going to be a big advertising thing. They're going to get lots of press, but either the app's going to be clunky, it's not going to be that good, it's not going to work, all these things. It turned out, no, actually, the app was fantastic. It looks nice and clean. Some people say maybe it's not quite as easy to use as a couple of the DFS guys who have been doing it forever. I think that's even debatable. It's very easy to use. But most importantly, and I'll say they have some cool innovations, the way you can do teasers, the way you
Mhm.
can pick the exact score of a certain game. These are definitely helpful things. But what is the big game changer is the way they are doing the, fade KFC, tail Dave Portnoy. And not only are they doing this, they are not doing this like arbitrarily or without
Mhm.
thought. They are doing it so cleverly. For example, right now, Amir Garrett
Yeah.
on the Cincinnati Reds, right? He's the one who called himself a bad mother effer and then threw an awesome slider. And Dave Portnoy was talking trash to him. And so currently on the Barstool app, there is the Amir Garrett soft serve prop, which is basically Dave Portnoy saying he will not strike out. No, it's saying that no one will score a run off him, or
Mhm.
no, he won't strike out a batter. Whatever it is, it's him talking smack about Amir Garrett and then saying, hey, here's the prop on how that pitcher will perform. Everyone come do it. And by the way, if you tweet or post on Instagram a screenshot of your bet, the Barstool crew might repost it and talk about it. And that is, talk about a game changer or something that's highly differentiated. There's not much that's differentiated in the market. The odds are pretty much the same. The available betting options are pretty much the same. That is a pretty big difference. And so I think, Penn now announced today they're raising about another $1 billion by selling more shares. People are, I think, definitely are impressed. It still remains to be seen, can they do this rollout in all the other states and scale? And I should note, a lot of people point to some of their, the social headline risk or whatever you want to call it. For example, Dave Portnoy at least makes it seem like he's placing all of these bets at the Barstool Sportsbook. But key employees of sportsbooks and casinos are not allowed to bet there. Now, it's totally conceivable that he's just saying he's placing them and he's not. But even things like that, combined with some of their history and some of their reputation, there could be some troubled waters. I know they have all sorts of new board members who are dedicated to responsible gaming and things like that. But overall, to sum all that up, they crushed it. They nailed it. They really hit it out of the park from a lot of different perspectives. I think, the opportunity is theirs to lose, and the marketing battle with how much FanDuel DraftKings these guys spend is very hard. But I'll be in Pennsylvania next weekend, and I am so pumped to
Yep.
just lose some money on this, on this sports book with no research or desire to maximize risk-adjusted return, because they've done a good job sort of capturing the social dynamic and the entertainment value around betting.
And I think that's one of the most important parts because again, it's the entertainment value, especially with here in the United States, why we like to bet. It's I'll put $10 on a game and then just kind of like it gives me more reason to scream at, Ken Harrison Bucker hit this 58-yard field goal 3 times in a row. I don't know, but I'm going to keep watching because either I win $10 or I lose $10. And while that's not going to change my day, it's just like it's kind of fun, little hit of serotonin, and we're happy about it, and we kind of move on from there. But I think the way that they're integrating their personalities, and the other thing is, as you were saying, like with how specific they get with that Amir Garrett one. I can't remember what it is. I love the way Dave Portnoy is like. I mean, I'm not a huge Dave Portnoy fan. Guy's kind of a dick, but like he's funny. Let's be honest. And I think the way he said is like if someone calls themselves a bad mother effer and then throws a slider, like that's not very bad of you, right? And like I think that's where it came from, and it's very organic how they're coming up with these bets and what they're doing and why they're doing it. And I think that they're just leaning into their audience. And I think the most important part is it's degenerate gamblers giving other degenerate gamblers just new things to bet on. And I think that is the fun part because, as you said, what's the difference between DraftKings and FanDuel? The biggest difference is that their player prop bets are like maybe 3 or 4 yards off here or there. That's what I've found is I'm just going to look at player props. Which one do I like more? Take the over, take the under on the book that I like the most. But outside of that, it's nothing. So in terms of customer acquisition, I know that's something that is super, super important. And I think you told me when we were on the phone, and I'll let you repeat the information, but it's about over what, $1,000 a person just to get somebody onto your sports book to start betting. I mean, their customer acquisition has to be crazy low because they have this insane following of people. And I wouldn't consider myself an insane follower, but of course I downloaded the book. And of course, when I'm in Pennsylvania in 2 or 3 weeks, whenever it is, I'm absolutely going to place a bet there and see what happens because shoot, why not? Right? I have it. It's funny. And they have all these interesting things that I can't bet on DraftKings or FanDuel. I can't bet on the total number of points on an NFL Sunday. I think that is just brilliant. So of course I'm going to do that when I'm there because why the hell not? Who doesn't love to root for points? So how have you seen in that case the opportunity with that Barstool has, especially when they do these rollouts in other states, to get that customer acquisition level down so much that this is a actual viable piece of the business because we know the margins on these are crazy, crazy thin because that customer acquisition is so high. It costs $1,000 for someone to get me on their sports book and I'm only betting $5 or $10. They're not going to get that $1,000 back very quickly if they ever do at all. So how do you think Barstool has the opportunity and some of these other media companies have the opportunity to actually get that number down enough to make this a legitimate, viable piece of their business?
Yeah, so you're absolutely right, first of all, to point out the cost of customer acquisition factor here. The sports betting industry right now could best be characterized as a customer acquisition gold rush. It is the most important thing. I would argue people are focusing too much on acquisition in the ratio or in proportion to retention, because if you acquire a bunch of users and
Mm-hmm.
don't retain them, it's kind of
Who
not
cares?
worth it.
Yeah.
However, yes, first of all, the whole bullish investment case around Penn Gaming stock with Barstool there is that primarily what it allows them to do is compete along the lines of cost of customer acquisition. You are definitely right that the hype that this drives. You and I were talking on the day of the Barstool launch, and I was saying, "Hey, I've been refreshing it a bunch. I heard it's not going to be till 3 p.m. and then it went live at like 1:45, and I shot you a note so you
Mm-hmm.
could refresh it." And I've never done that for an app
No.
before. That's crazy, right? And I'm also not a hardcore Barstool fan nearly the way that people who are their loyalists are. So that's a great point. To speak just to your question about what the number is, it's hard to get a consensus quote because sometimes, for example, what happens is some books will report their cost of customer acquisition and include bonuses and promotions, and others won't.
Mm-hmm.
But FanDuel and DraftKings, basically all of them right now, you get a $500 deposit match and a $500 free bet when you sign up. So that's $1,000 right there. On top of that, you're hearing a minimum of $250 in marketing costs per customer acquired. And so really you get these numbers anywhere from like the $500 to $1,000 to $2,000 range. You hear them talk about LTVs, customer lifetime values, of about $2,500. So they're happy to spend a decent amount because of that. And I should point out that there are some other ways. A very innovative product might be one way to acquire or retain customers. Another is innovative marketing. I can't remember if we talked about this on the last episode or the last time, one other time you and I spoke, but what PointsBet did with the Astros cheating,
Mm-hmm.
back when the Astros were caught cheating in the ALCS, PointsBet in the US was only live in New Jersey, where, of course, a lot of people bet on the Yankees to either win the ALCS or the World Series. They sent out a note: "Hey guys, the Astros cheated. If you bet on the Yankees, any future bets, we'll refund them. And if any of your friends or you bet on the Yankees with a competitor sports book, have them send us the ticket and we'll refund them up to $100." And was that because they're so philanthropic? No, of course not. It's because that allowed them to acquire customers at something like 1/10 the market rate, and not just pluck them out of the ether, but steal them directly from their direct competitors.
Mm-hmm.
So obviously there are some, at least, opportunities. There is some room for this. Now, all that said, there's only so much that you can do. There's only so many eyeballs and so many customers. I haven't really talked to anyone in the industry who thinks the mature state of it will have every single license occupied by a live operator. It just doesn't seem tenable, particularly if the big guys plan to keep offering these levels of bonuses and promotions and refunds, and engaging in partnerships that are just very either cash laden or don't pay them cash until later on. DraftKings has 1.2 billion in cash on the balance sheet and no debt, but most of their competitors do not. So what does that mean for customer acquisition dynamics? I think, first of all, you are going to be seeing so much building out of betting related content into any sports media, sports social network type platform, because they want to, if you are Bleacher Report, if you're The Athletic, if you're Sports Illustrated, especially the digital portions of these businesses, you want to best position yourself for the much higher form of sports engagement that is betting compared to just watching or something like that. Because certainly as things consolidate, and it puts you in a position to be acquired as a company, as a consumer and as a user. It puts you in the position to have more of a one-stop shop. DraftKings definitely, they want to not only be the sports betting platform of the future, they want to be the betting on everything platform of the future, but not just betting. For sports, just to use the example, you should be able to wake up, check the scores from last night, look at some funny NFL memes, do some research, pick some games for today, place the bets, watch the games, talk about them with your friends, withdraw the money from the bets, talk more crap to your friends that you were right and they were wrong, and kind of rinse, wash, repeat. That should all happen in one screen on one platform, and that will require a lot of innovation, and a lot of that will be driven by this customer acquisition problem. The other thing that you'll see a growth of, and we know this because we've seen it overseas and it's already starting here, is free-to-play games where you don't pay money to enter, but you can win real prizes. There's an obvious reason why free-to-play games are good. They kind of get you down the conversion funnel. They demonstrate as a user that you are likely to engage in whatever type of behavior. But perhaps more importantly, if you are DraftKings and FanDuel right now, you are benefiting enormously from your DFS pipeline that allows you to market to 18 and 21-year-olds, and then people start playing fantasy sports way younger than that. I mean, they start betting on sports too, but legally you can play non-monetized fantasy sports, I think probably at age 13, when you can, agree to terms and service. And so if you're anyone else, whether you're The Score or PointsBet or William Hill US, if you're trying to get a leg up in a new state, people talk about how big the first mover advantage is here. You can use a free-to-play game to make an impression on a state, spread brand awareness, educate customers, get people in that 18 to 21-year-old range, and things like that. So there's going to be a lot of interesting ways that people try to go about acquiring customers. What remains to be seen is how many big name operators can the future market really support. I think everyone agrees that DraftKings, FanDuel, and Roar Digital, which is the JV right between MGM and GVC, that those will be three of the very big players. Rush Street Interactive and all of the different Bet Rivers, Sugar House properties that it owns. William Hill, which reportedly is going to be doing a spinoff of its digital US business along with Caesars into some cool joint venture. Win Sports, they are spinning off, or at least they have their Win Sports Interactive brand. But now once we start getting to kind of some of these other names, it's not clear. 3, 4, or 5 operators that have market share, there's definitely room for those. John Levy, the CEO of The Score, recently made a comment that, you don't need high double-digit market share to be profitable. Mid-single-digit market share will be enough. And that is definitely true. But if you assume, let's say, that DraftKings, FanDuel, and Roar Digital each get about 25% of the market, that leaves 25% remaining. And how many slices can you split that up into? Maybe 5, 6, 7, 8, 9, 10. It's great if you're one of those guys. But more than that, the UK has hundreds of mobile sports books and even way more brick and mortar locations. It would be hard to see so many coexisting here in the US.
It's very interesting. And me, again, being here in New Jersey, I've had this opportunity for a couple years, just really started to take advantage of it, and noticed how many different places that I can go on my phone and just place a bet. Right? I just downloaded.
Well, let me ask you a question. What did you do to decide which one to go to first? Did you search best promotions? Did you just search Sportsbook in the App Store and download the first one? We can do a case study right now. How did you decide which one to place a bet with first?
I had some money on my DraftKings account, and I heard that I can place bets with it.
There you go.
That's literally
right?
it. Yep.
No, seriously, but that's a very important insight, because DraftKings and FanDuel can do that and benefit from that. I had something similar with FanDuel, so I know that exact experience. That is a real behavioral insight, and I'm sure you're not alone in that.
Oh, no. I mean, and that's the thing. It's really interesting. If you place money on the DFS side of it, you can't use that for your sports betting. But if you win money on the DFS side of it, you can use that money to place bets with it. So if I go in and I just get back my money, I say I put $10 into a game and I just get $10 back, I hit min cash or whatever, I can then now use that $10 to place bets. Even though it didn't really change, nothing happened, and I didn't put it on the sportsbook side, it now shows up on my sportsbook side, which I think is really interesting. So
Yeah,
I try and
there's a lot
build
of
up.
weird stuff, and
Mhm,
if you're used to playing online gaming historically, for example, your online casino wallet is
mhm.
separate from your online sportsbook wallet.
Yep.
Usually, there's two reasons why you see weird procedures around withdrawing money and betting. Sometimes it's just because they're not being very good faith companies, and especially in overseas,
Mhm.
unregulated or lightly regulated markets, the reality is the reason that you can't is just because they're being bad guys and giving you excuses. However, often what gets conflated with that, because people are just not aware of all sorts of things, is anti-money laundering is very important to be compliant to. And if you're FanDuel, DraftKings, you care way more about being 100% compliant than you do about, Michael getting a little pissed that it takes a few extra minutes.
Yeah.
So just for example, what it used to be in the old days in Vegas before sports betting was anywhere else, a classic way to launder money if you were a counterfeiter is you would counterfeit $1 million, you'd split it up into two piles of 500,000. You'd go to two different sports books and bet on opposite sides of the same bet. One of them is guaranteed to win. You pay taxes on that. You don't care about the other 500 grand because it was just paper. Now you have a taxable income, and now you can use that money. So Vegas kind of developed ways to detect that. Sports books would call to each other. Hey, I just got a new customer with this big action and all that. So, for a while, sports books have been trading information with each other. People have been trying to get around the system. These days, this doesn't work because they already figured it out. But just for example, you might be tempted to say, hey, I could just deposit $1,000 in my FanDuel account, get $1,000 worth of credit card points, and then withdraw the money from my FanDuel account and get free credit card points. Now, they figured that out already, and they process it as a refund rather
Mhm.
than as a return of cash so that you don't get the points. But the fact is, since a sports book and a casino are some of the only places where what you're buying is just money, right? You're just buying the transference of the digital representation of your money from one place into their backend. There are sometimes restrictions that might seem totally unintuitive that are because of AML, anti-money
Mhm.
laundering stuff. But that said, there also are some bad actors out there who just try
Yeah.
to make your life difficult.
Exactly. Yeah, it all goes both ways, and I understand that it's a new industry too, right? Sports betting is relatively new here. I mean, we know it's been in Vegas and it's kind of been like that underbelly, if I may, of sports. But now that it is starting to be legal in many of these states, I understand them going way far and above and then coming back down. It's hard to start something and then build it up, build it up, build it up just to piss people off along the way. It's a lot easier to just go way over the top. And then if you can, and you're legally allowed to, maybe relax those rules a little bit. That's usually like a psychological
Well,
way of
look,
going
there
about it
there
too.
is no question that even at the highest levels of this business, people realize that what you kind of need to do if you really want to hit it big is take an ask for forgiveness, not permission mentality.
Mhm.
Go big or go home, and then you'll gloss everything over by making donations to responsible gaming charities and paying and whatever you got to do. You'll pay the fines later, but now is the time to get market share.
Mhm.
And because the regulatory framework is so just fractured and balkanized, and regulators and legislators are so busy with a million other things, I think that sometimes people say something like, oh, how could Dave Portnoy be placing these bets if he's a key employee? Well, one answer is that he's not, and they very carefully executed this and thought it out. The other answer is they just didn't, and there's no, at least now, we don't have thought police here in the
Mhm.
US. There's no omniscient artificial intelligence that browses what you're doing. Until someone files a complaint that gets escalated to the state attorney general, you can do whatever you want. And even then, they have to figure out a way to get you to stop. So there's a lot of stuff that is yet to be determined, sort of in that sense.
Yeah, and it's interesting, and I love just kind of reading up on it. Follow Darren Ravel and make sure all of his. I do read his stupid tweets, but then he has some interesting ones too, and we appreciate those. And one
Well,
thing,
I will say, as insufferable as he is, and I think he does it at least somewhat
oh,
deliberately these days
100%,
because
yeah,
he's cashing in on the fade
exactly.
Ravel, mentality. one of the things that makes him cool, and this is how, Adam Schefter really made a name for himself, is he has access to at least some information that is of pretty cool general interest to sports business fans and sports fans. And he gets it out there. And so, all things aside, personality conflicts aside, he definitely does tell you some cool things about,
Absolutely.
the Super Bowl sponsor and how much they paid this year and all sorts of things. And so I do give him credit for that.
Yeah, I mean, I still follow him. Don't get me
Yeah,
wrong. I mean, I still follow him, so I don't know, jokes
exactly
on
right.
me and the
Exactly right.
other million plus people that follow him on Twitter, but it's definitely it's fun to say mean things at my phone after he does something because that's always
Of
important
course.
too. But with some of these things, so we talked about the number of sports books again being here in New Jersey. There is a plethora. At some point, they're going to have to drop off, as you explained. There's going to be 3-4 major players, and then there's a really small slice of that pie. The one thing that really interests me is with that means there's all these different companies. And one way for a company to raise a lot of capital is go public, baby, IPO, right? And I know one thing that these companies have been doing, and you had an awesome article. I'll make sure to link to it on YouTube as well as the podcast as well. Bill Ackman and SPACs. Now, I'm told you before, and I'm going to be honest and tell everybody here, I didn't totally understand everything I read. I read it, and I was like, this sounds interesting, and it sounds important. It sounds like I should know it, but I didn't totally get it. So if you don't mind, give us a nice high-level understanding of what a SPAC is, because we're seeing all these companies kind of twist off, as you said, and kind of like, DraftKings gets bought by someone, and then they kind of like spin it off a little bit, and they're doing all this weird shit that I think is really shady, and I don't believe in the financial market. I don't can anybody blame me. So just explain to me that everything that they're doing is legal and it's totally copacetic and we have nothing to worry about.
Yeah, let me explain to you what a SPAC is, why they're hot in kind of this industry right now, and then talk about briefly who Bill Ackman is and why I mentioned him and all that. So SPAC, SPAC, stands for Special Purpose Acquisition Company. And actually, the definition of what it is kind of in the name. It is a company that is created for the special purpose of acquiring someone. That's about it. Not to use the term in its own
Yeah,
definition. I'll get
give
there,
it to
but
you.
that's where it comes from. It's not like an arbitrary acronym or randomly thrown together letters. It really describes exactly what it is. So a SPAC, a special purpose acquisition company, is when someone raises a bunch of money, but rather than saying, I'm raising money to build more factories, or I'm raising money to build more planes, and here's how I know I can sell them and make money. It's I'm raising money specifically to take a company public. I don't know what it is yet. In my SPAC notice, I might specify an industry, or I might not. I might say something like, I want to take a company public in the sports and gaming sector. And if I want to incentivize investors to give me the money to do this, I might give some more details, like I am looking for a growth-oriented company in this specific stage that fits other specific criteria. Now, SPACs have been around for a while, since 2007 at least. And last year, they were getting really hot in the oil industry. And only because I think oil prices totally tanked last year did that not result in this kind of SPAC mania that people talk about in the sports and gaming industry now. So to kind of take this further, to use DraftKings as an example, what happened was some financial experts and people with investment management experience said, hey, this company DraftKings, they're doing well. I bet they could use a big capital infusion, and that will accelerate their growth. Let Jason Robbins and some of the other guys take some cash home and profit off, all their hard work, and allow DraftKings to become a public company. So they went out prior to having any discussions with DraftKings. When you raise a SPAC, you have to raise all the money before you enter into substantive discussions. What you do is you raise a bunch of money, and then once you put that money in an account that no one can touch, and you start finding companies to give that money to. And that money that you're giving them is the money that is used to take them public. In a regular IPO, lots of people can kind of buy those shares. It's not as organized. It first goes to institutions, and then you can buy it on Fidelity or Robinhood. But what's happening here is a specific person or a specific management group with a lot of expertise is saying, I'm going to get a bunch of money, and then we're going to take DraftKings public with that money. Now, in the particular case of DraftKings, and just to explain exactly what happened there, not only did DraftKings go from being a private company to a public company, They also merged with SB Tech, the provider of odds that they will soon use to replace Kambi. They merged with them and went public at the same time. And it seems a little confusing, but really all that happened was the guys that set up the SPAC, they went out and they said, hey, we are selling shares at $10 a share, and we're going to invest in something cool in the sports and gaming space. Who wants to give us money? And obviously it's an oversimplification, but they got together hundreds of millions of dollars, and they went up to Jason Robbins and they went up to Gavin Isaacs at SB Tech and said, hey guys, if we give you a bunch of cash, you all walk away with this much cash in your hands. Can we put these businesses together and roll them up into a single entity and make it public so anyone on the open market can buy shares? And they said, yeah, that sounds great. And so for a while, before DraftKings was the DKNG symbol that people have come to know, it traded under the name of the SPAC, Diamond Eagle Acquisition Corp. And so for months last year, I, as a holder of DraftKings, did not actually hold DraftKings. I held DEAC in my portfolio. And once the combination was completed, the ticker changed to DKNG. And from my perspective, I bought DraftKings stock. Now, just as a quick note before kind of explaining some other things here, the reason that people in general, as an investor, like investing in SPACs is when I invested in Diamond Eagle Acquisition Corp before it was DraftKings, had they identified a company that was really inopportune to acquire, let's say it wasn't DraftKings, it was someone else, before that gets pushed through, all the shareholders get to vote on it. And if it gets voted down, you get your money back. So when a SPAC says, hey, I got these shares for $10 a share, who wants to buy it? You can buy as many shares as you want for $10 and know that if you don't like the company that's going to be acquired, you can get that $10 back. And that's just a very appealing thing, especially when kind of new, cool, hot companies are coming to market. Now, why have they been so popular?
Well,
Because
actually, can I stop you right there? So
sure.
how did you know to buy Diamond Eagle Acquisition Company?
Sure.
Because it sounds like, again, you're not allowed to say who you're trying to or you're not allowed to say who you want to take to market beforehand, right? That's what you said before. So how did everybody know, hey, we should probably buy this SPAC because there's a really good understanding they're going to go out and buy DraftKings, even though they're not allowed to talk about that until they raise all the money?
So there are two ways. First of all, this is why, if you're asking who are the people who bought at $10, not $10.01, not $10.10 after some momentum buildup, who bought the $10 shares to start with? The question is great. And first of all, you could apply that question to how does like any first time hedge fund manager raise money to invest, right? You have a pitch deck and you convince people that you have a good plan, a business plan. A pitch deck is kind of the answer to your question. But the other part of it is, well, this is why so many people with high profile names are getting into the SPAC game, because you can make a ton of money. And if you have a personality that is associated with success, either as an investor or in the industry, you can raise the money very quickly. So, for example, Billy Beane is now working on a SPAC with the same company that helped buy the XFL with The Rock. And just because they announced that and said Billy Beane teams up with company that bought XFL to raise SPAC, people are going to buy it simply based on those guys being involved and the hotness of the SPAC structure. After that, though, once the initial shares have sort of sold, and then the discussions get started. So, for example, right now, if you were to look up the ticker LCA, that is what everyone pretty much knows is almost definitely going to become Golden Nugget Online Gaming. And that ticker will change to GNOG or GNOG, as people say. And similarly, if you look up the ticker DMYT, that is the SPAC that is taking Rush Street Interactive public. And so that is known right now. And as news comes in about those companies, the prices go up and down. And not only this, but there's a rumor mill, just like with anything. There are websites dedicated to SPAC issuance and Twitter accounts dedicated to speculating. Sport Radar, for example, is the lead number one kind of data provider to all sports books. They've had investors, Mark Cuban, Ted Leonsis, Michael Jordan. and they are going to go public, possibly through a SPAC. So if you heard, hey, this guy I really know and respect started a SPAC, he wants to raise the amount of money that I could see making sense for a sport radar takeover, and he's issuing it toward the sports and gaming industry, say, hey, I'm going to buy these for $10 a share. Worst case, I vote against it or get my $10 back before it's too late. And so that's why these things get so much popularity. But why are companies using them? Why is it so hot? It's really for two reasons that are happening at the same time. First of all, compared to all the other ways that you could raise a ton of money really quickly, IPOs are the most popular one, but some companies like Slack have popularized some small alternatives. Slack used something called a direct placement. But anyway, as far as all the ways that you could raise like hundreds of millions or billions of dollars, a SPAC allows you to do it the most quickly during times of financial or market instability, and allows you to use forward-looking financial projections in your sales pitch. Now, that last one is sometimes what concerns people and gives rise to concerns over transparency. Generally, when you invest in a company, you look at audited historical financials. But for a SPAC, that doesn't have to be the case. They can say, hey, here's our projections. Now, hopefully, smart people look at those projections and see. Now, just to really give you a sense of the scale of this, of how much money you can make if you not are an investor in a SPAC, but run one. First of all, if you invested in DraftKings at $10 and they're at $50 now, just 6 months later, especially through COVID, that's obviously great. Goldman Sachs, they recently closed a SPAC. They helped raise $140 million and at a $700 million valuation for a company. The standard way that if you are Goldman Sachs or if you are Billy Bean or you are Diamond Eagle Acquisition Corp, the way you get compensated for all your hard work, the way you get compensated for the fact that you have a big name that could go out and ask people for $10 a share and raise all that money, you get what are called founders shares. You get basically 20% of this new thing for some negligible cost, basically for free, between $5,000 and $25,000. So for example, when Goldman Sachs helped raise $140 million, they helped raise $700 million through a SPAC. They had to spend $5,000 on their founders shares that the minute the deal closed were worth $140 million. They raised $700 million. They get 20% founders shares. 20% of $700 million is $140. You're forced to pay something, some number under $25,000, I believe is the convention, for those founder shares. But that's a pretty damn nice profit for a relatively small amount of work that doesn't require all that many people. It does require you being Goldman Sachs in the first place and the 100 years of work that went into that. So let's not discount that. And then there are a number of other particularities. But what's going on right now is SPACs are good for taking companies public during times of instability. And they also are good for companies that are in their hyper growth phase. If you're too early and you're not growing yet, or you're already very mature, a SPAC is not likely to be ideal. So we have this nice perfect storm here where all these companies are growing quickly. And obviously, it's times of instability from a market perspective. And then what you add on to that is that all of these companies, Golden Nugget is probably the one that kind of spearheaded it. They're recognizing that digital is the way of the future. Brick and mortar is nice. It's good to have a presence. It's good for brand awareness, all that. But realistically, your scalable revenue generating operations of the future will come from your digital channels. And, so to separate that, and what some people would say to unlock value that currently is not represented in the share price, what you have is companies saying, we want to spin off our digital assets. We want to take our one company that's physical and digital assets and make it two companies, one for physical stuff and one for digital stuff. But not only do we want them to be separate, we want that spinoff to be a public company. A SPAC would be the best way to do that. So to come full circle on what we've been saying here, I could go out and say, hey, everyone, give me $10 a share and I'm going to do something cool in digital interactive gaming. And then I could go to a big gaming company that has both a brick and mortar and a digital business and say, hey, do you want a few $100 million for some portion of your digital business? And we'll make it public and now it can trade on the open market. So that is what is happening a lot. One of the ones being talked about right now is William Hill US and Caesars doing a spinoff that would allow Caesars to better capitalize on all of their CRM and their digital assets and things of that nature. Now, there's all these great things, but SPACs have been criticized for a few things historically. And one is just the potential for lack of transparency that can happen when you're using pro forma unaudited financials. And just in general, when anyone tells you, hey, I have a magical way to do something really fast during a time of chaos, there's bound to be some possible downsides. And there's really two principal ones that come to mind. One is the possibility of facilitating a bubble where valuations just get really high. If an area gets really hot and all these companies realize we can go public and that SPACs are really hot, and that as soon as we do a SPAC, our valuation just goes higher, it kind of becomes like a self-fulfilling prophecy, and the valuations could run away from themselves before they actually make any sense. The other criticism that has been used historically is that they are overwhelmingly friendly to the sponsor, the Goldman Sachs, the Billy Bean, and not friendly enough to the investors and the founders and the business owners. Bill Ackman, to bring him in here, he is a world famous hedge fund manager, one of the richest guys in the world. He became very famous because he not only campaigned against, but shorted the stock of Herbalife, calling it a pyramid scheme, and was the front and center guy trying to take that business down. And he's been involved in a number of other, sometimes he's referred to as an activist investor, because he's involved in all sorts of interesting things. And he's always kind of on the news. People look to his opinion. He recently came out and said, I am doing a new SPAC, just like a bunch of the other guys, but mine is going to be different. And there's a lot of little differences, but the big difference in Bill Ackman's SPAC is that he does not take founders' shares equal to 20%. He takes 0%. He eliminated that whole thing that for Goldman Sachs would have been 140 million that comes out of the pocket of the other people involved in that deal. So that is called Pershing Square Tontine Holdings, PSTHU is currently the ticker. And they are in the process of, you can trade that on the open market. No one knows exactly what they are going to purchase. Some people have said it could be Sport Radar, but people don't really think so anymore. But that is what he is doing. And so now some people are saying, all right, SPACs are hot and they probably are here to stay at least for a little while. Will there be some changing of the status quo of how these things are structured from an incentive perspective? And along the way, can we maintain the level of transparency and integrity, especially in the gaming industry where some companies have historically made revenue from Iran and Turkey and countries that could be problematic for US investors? You know, how can we balance all of these things? It's a phenomenal way of supplying capital. It's a phenomenal way of getting founders to earn some cash for their great work. There are, of course, some risks, as there always will be. It seems like for now, there certainly is a high level of, I call it tier one institutions that are involved in these things. Jefferies is the investment bank that is doing the Golden Nugget SPAC deal. Wall Street firms with way more to lose than they could ever gain from a small gaming company going public are getting involved, and that is giving people hope. But look, it remains to be seen. If you follow financial news, the company Nikola right now, they went public via SPAC. They are the electric car company that has been in the news for fraud because the commercial that they used of their 18-wheeler truck allegedly driving really fast was not actually driving. It was rolling down a hill that had to be towed up, and their founder just resigned and shares went down 20%. Maybe had investors had access to more conventionally audited financials that adhere to what are called generally accepted accounting principles, or GAAP, maybe that wouldn't have happened. I don't know. I'm sure if that thing gets revealed to be a total Theranos type fraud, people will point to the SPAC structure as at least a possible culprit. But we're kind of in the early days of seeing how viable is this as a long-term strategy. Certainly for the next couple of years, I think you should expect to see a number more.
Yeah, thank you for all of that. That was an incredible breakdown. I appreciate it. And I like that other guy and what he's doing, because who am I to say what Goldman Sachs's name is worth or Billy Bean's name is worth, right? Like, is it $140 million? But it just sounds like that 20% number is very high. Now, I'm not a mathematician. I'm not an accountant. I used to be a financial advisor, and that's why I got out of it. But that 20% number just sounds crazy high. And as you said, that 700 million, you snap your fingers, turns to 140, right? But then it's the price just goes up and down with the market, right? It just goes
Well,
up and
so
it goes.
just to point out, how that worked, just to use pretend numbers for a second. Um, yeah, first of all, you're right. Who is anyone to say how much anyone's name's
Yeah,
worth? But then
exactly.
think about it like this. Let's say that the amount of, we'll use very small round numbers just to drive a point. Let's say the total amount raised to take DraftKings public was $10, and that the investment bank that did that on day one got two of those dollars. So Jason Robbins has $8 instead of 10 total, right? Because the $2
Mhm.
immediately went to the investment bank. But if the shares go up from $10 to $100, Jason Robbins now has $80 instead of 8.
Mhm.
And does he care about having $80 versus $82? Probably not. So if by taking the company public, an investment bank or a Billy Bean or an anyone can quickly bring a company into the capital markets and those shares go up even more, I don't even know that it's fair to say that anyone got ripped off. They kind of
Mhm.
all, came out ahead. So that's why it's extra confusing and extra
Yeah.
appealing to be involved in one of these deals.
Yeah, and again, I'm sure there's obviously both sides to the argument. It definitely sounds like some shady shit, though. I think we all can be very open and honest about that. It sounds like something that, yeah, there will be some, as we've already seen, and as you pointed out, there will be some people raising eyebrows and questions at some point with a couple of these companies. And
Look, the
hey,
combination of a new structure that has some transparency concerns combined with an overregulated industry that for many has a social stigma, that is absolutely
yes.
inviting extra eyeballs, to say the least. No question
Yes,
about it.
that is true, and hopefully everything stays copacetic. And after we're done, I can write down all those ticker symbols when I go back and listen, because it sounds like something that I'm going to want to do. But Lloyd, this has been absolutely fantastic. Almost an hour. I feel like I could talk to you a lot more. I think I honestly only got to about half my questions, so maybe we'll just have to do this in a couple weeks again. But everybody, ladies and gentlemen, Lloyd Danzig, founder and CEO of Sharp Alpha Advisors. Where can everybody find you on the internet?
Yeah, Twitter and LinkedIn are where I post a lot of my articles and conferences I'm speaking at. I have a website, just my personal website, lloyddanzig.com, where I also find that stuff. Because my name's a bit unique, really, if you Google Lloyd Danzig or Lloyd Sports Betting, most of my stuff comes up that way.
Lloyd Sports Betting. Sounds like a pretty sweet personal brand you got rocking there, man. Make sure to
I'll
take
take
advantage
it.
of that. Yes,
I'll
I'll
take
get
it.
all those links. They will be on the notes in YouTube. They will be in the show notes for the podcast. Lloyd, this was great, man. Really appreciate all the insight and the intelligence flowing our way. Thank you so much for your time today, man.
Thanks, Michael. Stay safe.